Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Insurance is the third pillar of African financial services, alongside banks and diversified financial services. The African insurance industry is one of the most underpenetrated in the world, with total premium volume of approximately $90 billion United States dollars, representing less than 2% of global premiums despite Africa holding 17% of the global population. This low penetration is both the challenge and the opportunity. Every percentage point increase in insurance penetration represents approximately $50 billion of additional annual premium. This presentation examines the African insurance industry as a whole, before drilling into life and health, multi-line, property and casualty, and reinsurance in companion videos. The African insurance industry generates approximately $90 billion United States dollars in annual premium, split roughly equally between life and non-life business. Insurance penetration, measured as premium as a percentage of GDP, is approximately 1.8%. Well below the global average of approximately 7%. Premium per capita is approximately 65 United States dollars, compared with the global average of more than $800. More than 600 licensed insurers operate across the 54 African markets, with significant fragmentation in markets like Nigeria, Kenya, and Egypt. The combination of low penetration and significant fragmentation creates both a structural growth opportunity and pressure for industry consolidation. The largest listed African insurers are concentrated in South Africa. Sanlam Limited leads with a market capitalization of approximately $10 billion United States dollars, followed by Old Mutual at $7 billion, Discovery at $6 billion, and Santam at $3.5 billion. Momentum Metropolitan, OUTsurance, Liberty Holdings, and Hollard round out the South African top tier. Outside South Africa, Britam Holdings of Kenya, with a $400 million market capitalization, is the largest listed insurer in East Africa. The South African dominance of the listed insurance market reflects both the depth of the South African insurance industry and the listing culture of South African financial institutions. Insurance penetration varies dramatically across African markets. South Africa alone has insurance penetration exceeding 12% of GDP, driven by a sophisticated life insurance market and well-funded pension system. Excluding South Africa, the rest of Africa has insurance penetration of approximately 1.5% of GDP, with Namibia, Mauritius, and Botswana the only other markets above 2%. Nigeria, despite its large population and economy, has insurance penetration below 1% of GDP. Kenya and Egypt sit at approximately 2.5% and 1% respectively. The low penetration outside South Africa represents both the structural opportunity and the structural challenge. Millions of customers need insurance, but distribution, affordability, and trust remain significant barriers. 5 structural barriers explain low African insurance penetration. Low income levels. Insurance is a discretionary spend that competes with food, shelter, and education for limited household budgets. Informal economy. The large informal economy means many potential customers lack the formal income documentation required for traditional underwriting. Lack of trust. Historical issues with claims payment, weak regulatory frameworks in some markets, and limited consumer education have eroded trust in insurance products. Limited distribution. Outside South Africa, insurance distribution is fragmented and underdeveloped, particularly in rural areas. And religious and cultural factors. Some religious beliefs, particularly in parts of West and East Africa, can be misinterpreted as conflicting with insurance principles, suppressing demand. Life and non-life insurance have different characteristics. Life insurance represents approximately 55% of total African premium, with South Africa accounting for the majority. Life insurance products include traditional life, funeral cover, retirement annuities, and credit life. Funeral cover is a particularly African innovation, providing affordable coverage for end-of-life expenses. Mobile microinsurance is emerging as a high-growth category. Non-life insurance represents approximately 45% of total African premium, with motor insurance the largest single line. Other significant lines include property, marine, aviation, energy, agriculture, and engineering. Agricultural insurance is growing rapidly, supported by government and development finance institution premium subsidies in markets like Kenya, Nigeria, and Zambia. Insurance supervision is national, with growing regional coordination. The South African Prudential Authority regulates insurers under the Insurance Act of 2017, applying a solvency assessment and management framework similar to Solvency II in Europe. Nigeria's National Insurance Commission regulates insurers under the Insurance Act of 2003, with ongoing reforms to strengthen capital requirements. Kenya's Insurance Regulatory Authority regulates insurers under the Insurance Act, with capital requirements recently raised. Egypt's Financial Regulatory Authority regulates insurance alongside other non-bank financial services. The Africa Insurance Organization, headquartered in Cameroon, provides a forum for regulatory coordination, while regional bodies like the Committee of Insurance, Social Security and Pensions regulators in West Africa work toward harmonization. 5 emerging product categories are driving structural insurance growth. Mobile microinsurance. Products distributed through mobile money platforms, with premiums deducted from mobile wallets and coverage triggered automatically. Agricultural insurance. Index-based crop and livestock insurance, supported by government subsidies and weather station infrastructure, is transforming rural insurance. Parametric weather covers. Covers that pay out automatically based on weather triggers, rather than indemnifying actual losses, are gaining traction for catastrophe risks. Cyber insurance. Emerging as a growth category, driven by increasing cyberattack frequency and regulatory data protection requirements. And health insurance. The fastest-growing life and health category, supported by expanding middle class and rising healthcare costs. The South African insurance anchors define the African insurance industry. Sanlam, founded in 1918, has grown into a Pan-African insurance group with operations in more than 30 African countries and a market capitalization of approximately $10 billion United States dollars. Old Mutual, founded in 1845, is one of the oldest financial institutions on the continent, with operations across Southern and East Africa. Discovery, founded in 1992, has pioneered behavioral insurance through its Vitality program, with operations in South Africa, the United Kingdom, the United States, and China. Santam is the largest property and casualty insurer in South Africa. Momentum Metropolitan, formed by the 2010 merger, rounds out the major listed insurers. Together, these 5 firms dominate the South African insurance market and provide the most sophisticated insurance products and services on the continent. In summary, African insurance premiums will grow at high single to low double-digit rates over the next decade, with mobile distribution and microinsurance leading. Consolidation will accelerate as subscale insurers struggle to meet rising capital and technology investment requirements. Mobile microinsurance will redefine insurance unit economics, enabling profitable coverage of customers previously considered uneconomic. And climate risk and cyber risk will emerge as the most significant new product categories over the coming decade. The insurance industry is one of the most attractive structural growth stories in African financial services. Thank you for watching this overview of African insurance.